There's always millions, tens of millions on these things. They're not small trades. They're not like to this. Unfortunately, they were shorting the wrong stock. But by the time they realised it caused like absolute chaos. So, the company they worked for started getting rung up by the regulator because it looked like they were doing a hostile takeover on this stock.
Hey everyone, Ben here and welcome to Motivation to Invest. Today we're going to be joined by a very special guest. His name is Alex and he's a former trader at CITI, which is the third largest investment bank in the entire world, just behind JP Morgan and Goldman Sachs. So in this video, Alex is going to reveal to us what is it really like working for a major investment bank. We're going to dive into his background, his motivation to invest, and maybe even some of his tips he can provide for us on our own investing journey. So this is going to be a really exceptional video, guys, and I think you're going to like what we've got for you. So before we hop right in, if you do appreciate the value in this video, feel free to give it an early thumbs up. That helps out tremendously with the channel. And if you haven't joined the investing family yet and you do like these investing tips and interviews, feel free to join by hitting that subscribe button and turning that notification bell on. And with that being said, let's dive in. Right, Alex, great to have you here. So what was your motivation to invest? Tell us a little bit about your background, how you got started.
So my journey into investment was probably a bit different than most people who end up trading at a investment bank. The normal route that people would take into that would be recruited out of university, and they've had an aim and made sure they've put themselves in that place where they are seen as a prime candidate to get picked by that.
Like a high-end university.
Exactly, like a global university with a reputable program. The route that I took was I'd left the army. I found myself in London. I found myself at a careers fair and got offered a 4-week unpaid internship at CITI. And from that, I then got offered a job in back office. I did that for quite a few months, like 8 months or so. And then through just being good at what I did, but also making connections and talking to people, I then got offered a middle office role working with a trading team. And then from that point, I was put on the trading desk itself. So that's not a route that I would suggest anybody to take because there's too many variables, there's too many bits of luck, judgment, opportunity that come into it.
You might get shot in the army.
You could get shot in the army beforehand. I'm not sure if if the army gave me any skills that would necessarily transfer across.
Hasta la vista, baby.
But I think generally you have to kind of go to like a top-end university and get recruited that way if you want to make it sure. So that's kind of how I got started.
Did the army not give you that maybe discipline or work ethic? Did it add anything?
Maybe some others, maybe not me. I think I'm quite resistant to things, and I have my own mind. I think that sort of strength of character enabled me to go into different environments and make my own judgment, which is I think was my USP versus other people. So when you get the people from the general kind of recruitment background, exactly, they've done the right courses, they say the right things, they've been to the right university, and that's fantastic. But then I still think with any team, you still need people who see things slightly differently, that bring a different aspect to that team. And
independent thinkers are very rare, I find. Like in a lot of jobs, in a lot of industries, even in investing and also trading, people follow like sheep and like lemmings, and then if there's a situation or there's some sort of setup and people say, well, why is it like that? They'll say, well, it's always been like that.
This is absolutely true. I mean, we've all worked in jobs, and no matter where you are, what industry you're in, that will be the generic thing. We just do this process, and the only answer is just because we've always done it, which is an absolute terrible thing to say. So I think because I came from a non-traditional background and because of the way that I was brought up, I was always questioning why we do things, and that just enabled me to see things I thought were pretty obvious, but weren't obvious, otherwise it would have been implemented in a different way.
Traditional educational institutions, they teach people to really think in a box and just get the right answers to exams and stuff like that, whereas if you went the army route and then a really alternative route, so perhaps they brought you in as a bit of a wild card because you're going to be you think outside the box, you think independently, and that can add something to CITI, obviously major investment bank.
I mean, I think because of the route I went, I was able to prove my value at every step.
Here's a question: is the smart money really the smart money? So in these big investment banks, you've got these supposed to be the best minds in the world. Are they really smarter exponentially than, say, somebody who studied it independently?
Everybody truly thinks the smart money is somewhere else, if they're honest with themselves. I think there are a few firms out there that seem to be smarter than others, which I won't name, but I think that generally, like, if anybody thinks they are the smartest money in the room, then you're definitely not.
It's good to be humble and also self-aware. Because if you think you know it all and you think, right, this is the smartest possible investment, smartest possible trade right now, then there's probably going to be somebody else smarter somewhere doing something else that's maybe completely different. So,
absolutely.
So do you have any funny stories from when you were inside the investment bank?
I mean, funny stories always depend on your aspect of which side you're on. But I think when you look at retail investors, and you find sometimes you get confused with the tickers, and you maybe bought the wrong stock, or it's not the stock you thought it was, and you bought it on the wrong exchange, and all those things. You think, I'm sure these smarter guys at these big funds don't suffer these unfortunate things. Smart money don't suffer these unfortunate things. They absolutely do. I mean, there was an incident I was aware of where somebody was trying to short a stock, and they were hoovering up all around the market, and they thought it was going so well that I can't believe I'm like the only person onto this. Unfortunately, they were shorting the wrong stock. But by the time they realised it caused like absolute chaos. So, the company they worked for started getting rung up by the regulator because it looked like they were doing a hostile takeover on this stock when, it's that level of stuff when it really goes to the top level. And then unfortunately it's going to filter down at some point.
Because was it a smaller cap company than the company you thought it was?
It was both companies started with green, and the latter part of the name was different. But when you're just looking at a ticker and you it's early in the morning, and maybe haven't quite listened to the briefing that well, everybody's out there trying to get what was the hottest short on the market, and you're going around getting all this sort of this stuff in, and you think you've done a stellar job, and you know what a brilliant job I've done, but then later in the day when you can't settle your stuff because it's the wrong stock and it's unwinds, it becomes very very awkward.
So how much cash was sort of at stake there? How much?
I don't know on the actual
approximate.
I don't actually
millions.
Know on that. There's always millions, tens of millions on these things. They're not small trades. They're not like, because to make money on these things you have to do it in. If you're going to have conviction to do something, you do it, and you try and do as much leverage as you can. So there is. It's not a cheap or a quick fix mistake. But say. Mistakes happen even with the smart money.
What happened to that guy after that situation? Obviously,
I think it wasn't the best for him. I think it's one of those things. So look, it can happen to anybody.
The show goes on.
And it's just unfortunate that it happened to.
Well, this is where whether you're working for Goldman Sachs, Citigroup, or you're an investment banker or you're a retail investor, you're all human being. So you can have biases. You can have and be emotional.
Just calm down.
I am calm.
You can make mistakes and. It's in a way it's inspiring for those people starting out investing, because you can see that obviously there's a pathway everyone makes. Even the great Warren Buffett, he's always making mistakes. But the real amazing thing is being able to admit the mistakes, be self-aware, and say, okay, I was an idiot, I made a mistake, and then you can move forward. And the difficult thing, and I think the negative thing, which can affect anybody, no matter what level they are in the industry, is if they're in denial and they think, well, actually, I didn't do anything wrong. Because then they can keep making the same mistakes again and again.
I think it's where this idea of smart money comes from, and this idea that there's this big sort of division between the retail investor and then these big finance guys who've got all the information. Look, they make mistakes as well. And I think as a retail investor, you think, it's because I wasn't in the know or something happened. But it's also just because you say you've got those underlying biases. You're an emotional creature, you're a human creature. If you had two parallel days and you were buying the same stock, how you felt about buying the same stock if you had a really good morning or you had a really bad morning will feel very, very different. And therefore, would your risk parameters slightly change? Would your optimism slightly change upon seeing a bit of news? So I think just being aware of that as a retail investor, especially if you're on your investment journey, and just trying to be aware of it, as you say, making sure that you feed back any learning you have and try and build that into your strategy. But also, it's not just a question of, you're never going to be able to get to the level of the smart money. You've got to do what's appropriate for you. I started in the market in 2007, 2008, so literally like the huge financial crash, and the market wasn't the best. So my aspect of the optimism on the market is kind of probably less than somebody who started during a more effervescent period. So, and it was quite funny. So one of the fund managers I worked for, he started just after 87, so everything was on the up. So he's very positive about being an active fund manager, and he thinks he can pick stocks, and he does pick stocks. He does really, really well. Where for me, when I was trading my product, and we had, we used to work with arbitrage strategies, so you can make money on the up or down. But we also worked a lot with short selling strategies for hedge funds, and then bringing that money back to the long fund to sort of finance their costs. Then that made sense to me, because in that market everything was going down. So if you've got a stock that's going down, but a hedge fund's going to short it and then give you some of that profit, as a long fund, you're thinking, brilliant, because we've got to hold this for our investment for 10, 20, 30 years. It's having a little blip at the moment, but in 10 years' time, 20 years' time, it's gone up. But during that really bad period, we've also earned money. So I think that's the sort of the aspect I'd like to sort of have the retail investors take away, that short selling isn't this absolute terrible thing. What it stops you doing, for me as a retail investor, is having a really poor company or really bad investment being overvalued. You buy into it with all the merits that should be given to that, and then you find yourself on the wrong end of something.
That's the real issue with these. Obviously, there's a lot of short squeezes have gone on recently. And I say this on the channel, the real risk with that is the fact that hedge fund has done a lot of research in the shorting that stock. They've done it for a reason, because they believe it's overvalued, the fundamentals are poor, it's a declining business. So to actually get a short squeeze, it can work sometimes if you get enough, obviously, momentum behind the stock, and then they have to buy the stock back to actually, and it further obviously escalates the share price. But there is a major risk of that. Like I know there's a major short squeeze that happened with Tesla even before all this GameStop issue. And Tesla, great company, I believe, overall, but there was a lot of people shorting that stock at the time who didn't have faith in the company.
We saw the situation with GameStop at the beginning of the year, and you've got this idea that the retail investor, and they're trying to give it to the big guys, and we always use these hedge funds as these terrible, evil caricatures who are sort of sitting there. These are the big money, but when you're in the investing space, hedge funds are tiny. They're really like small players. When you've got sovereign wealth funds, with hundreds of billions of dollars, and you've got a little hedge fund that can have a couple $100 million, you see the difference in scope, and therefore I don't see it as starkly as some of the retail investors see it. Now I get the idea that their premise is correct from their understanding, but the way I look at it is, the reason you would short sell anything is because you think the stock is overvalued. So what generally happened after the financial crisis in 2008 is a lot of governments tried to ring fence certain stocks, mainly financial stocks, because of the pressure they were suffering. Now you said you can't short sell these stocks,
because they know the fundamentals are bad for the company.
Exactly. So I'd have my long funds who had these stocks, and you'd have hedge funds who wanted to short them. Now in some countries you can do that, and in other countries they wouldn't allow it. Now the argument was that if you short sellers drive down the price, but if you're Warren and the price goes down, what are you going to do? You're going to buy. It's a buying opportunity, and therefore the value of anything should be determined by the market. And therefore, if you restrict market dynamics, you actually create an artificial bubble. And just because you try and protect a stock, and it happens with a lot of financial stocks, especially in like Southern Europe, it doesn't make them any better.
Zombie companies.
They're zombie companies. They're doing capital raising. So you're an investor in the company. They're doing another capital raising this year, and the next year, and the next year, and you're throwing good money after bad. You've got stocks in Italy that, one of the oldest banks in the world that was protected for years and years and years, and eventually went bust recently. And you're thinking, well, you can't restrict market practice and then artificially create a healthy environment for stocks to be traded in where the true value is given. Wall Street Bets and all the Redditors and the way they approach stuff, I think it's fantastic. I think it's fantastic. People are interested in investing, and I really encourage people to become more educated in that space. I think you've got to be very careful about drawing arbitrary lines that don't exist, because you can find yourself fighting a battle for no reason.
Well, it's a bit like retail activist investing, and I've said this on previous videos. I've said, just know why you're investing or why you're trading. And the idea is obviously to make a profit.
Yeah.
If you're doing it for some sort of protest reason or because you want to take on the big bad hedge fund.
That they may take our lives, but they'll never take our freedom!
Then your motives have changed, and that can also influence you with plenty of biases. So you may invest poorly, you may trade poorly, you may hold the stock, as they say, even though it's a poor company like let's say GameStop or AMC, despite all the fundamentals of the business or even the technicals, just because you're trying to actually bankrupt a hedge fund. So I just think it's quite dangerous, but I do understand, like you said, the reasons behind it, and I feel there's a lot of frustration in the market from retail investors because they feel they haven't got a level playing field against the hedge funds.
I wouldn't say that the skill set for an investment banking career is very, very different, and I think personally a lot easier than being so for example, I've worked with a fund manager, one of the top fund managers in the UK in his sector, and his job is exponentially harder because he has to prove himself every day, every year, with a track record and keep on producing that, where when you're in investment banking, you're a trader in investment banking, you're trading a product, and it's about building those relationships, make sure you've got things that are going to keep on working, but you're not necessarily having to go out and making direct investment decisions that people are then going to judge you on.
Trading floor, how is it all set up? What was your sort of role in that?
Citigroup's a huge institution, so the trading floors would generally be split up along sort of like asset lines. You'd have an equity trading floor, fixed income trading floor, your commodities trading floor, your FX trading floor. So I was primarily sat on the equity trading floor. But within our team, we had a couple fixed income guys and a couple cash guys as well, because of the products we traded. We needed that outlet. Now, when you look at a trading floor and you see these films and you've got all these screens and hundreds of people, they're all sort of shouting and whatever they're doing.
Is it really like that, or is that all?
I think it's quieting down now because it's obviously a lot of stuff's done on the phone, but it's still a very vibrant and loud environment because of the personalities you've got there. But also, you need to convey information. And the people around you in your trading team, the reason you have that open structure is because when I'm on the phone to any of my clients, I also need to be listening, for example, to the 5 other guys behind me about what they're doing, because what they're doing could also have an impact upon me. There is the reason you sit relatively so close and in such a open proximity is to open those barriers that you would normally have in a normal office.
I see these movies and you see people going like, you're effing like really aggressive, like, but why don't you put that trade? Is it like, do you get that sometimes, or is it just certain or was that maybe 10, 20 years ago? Is it more, I think a little bit more chilled now maybe?
I think obviously it is, nobody had a problem with people swearing, I don't think, but then I think that the old style that people have in their heads has pretty much gone. I think one of the best scenes that really like sums up how a trading floor is, it's only one from one phone call kind of aspect. So you haven't got the nature of 100 of these phone calls going on at the same time. Is a scene in Margin Call where he's selling the assets down, and I think that the way they talk on the phone, the terminology.
Hey, it's Will Emerson.
William, how are you?
I'm alright. How's the trouble and strife?
Busting my ass as always.
You see, that's why I tried to tell you, John. Why do you think I'm single?
I know you did. What can I do for you?
Listen, I just got the tap on my shoulder, and we've got some risk over here that we need to move. So today it looks like my loss is your gain.
What kind of size we talking?
Should be on your screen. I just sent it.
Jesus, where does this land?
96 on the dollar.
91.
All 3, and we're done at 94.
93 and a half.
Done.
So what are some positives and negatives?
The best one is you get to make decisions. And that depends whether you like it or not, but I like making active decisions, and I like making decisions pretty often. Otherwise I'll ruminate and think about things for days on end. So when I'm forced to make a decision, and I've got to make a decision every minute, and I'm working for like say 8, 10, 12 hours a day, depending on the time of year, you don't get decision fatigue, you just get used to making decisions, and therefore you actually find it easier to make better decisions because you're in that frame of mind. Downside of that is
what does make the wrong decisions maybe, because you're making quick, fast, definite decisions. So does as much thought go into it as if you'd make a...
I think because of if you're an active fund manager, you make decisions at a slower pace.
Yeah.
Okay, so you got that value investing.
Yeah,
Warren's idea.
Warren
so
Buffett,
that
more
is
patience.
Exactly.
That's actually what I'm trying to do at the moment. I'm trying to not make it, because I'm a bit like you in a way. I like to make quick, fast decisions. I actually prefer that, but I'm actually trying to not make as many decisions as fast, so I don't jump into something a bit too aggressively.
Yeah, and this is the difference. We'll touch on this later with where my career has gone, but this is the real difference between trading and investing, and people confuse the two terms. So if you're an investor, you're looking over a much longer time frame, and you should leave things alone and not overreact just because something's happened or hasn't happened. When you're trading, and I'd say it probably makes sense at this point to kind of go into what my role was and what my team did. But you aren't making those kind of investment decisions based upon what you think the future of a stock may be. For example, you're trading around the product. So yes, you can make wrong decisions, but it's not as arbitrarily seen as, oh, I should have held the stock and sold it here, or I should have bought it here, and you know, those classic kind of ones. So the downside just from having all that, the time you spend in the job and the intensity of the job can have an impact upon people's health and their other parts of their life. And that's another reason why, as you see later on in the journey, I want to start bringing a few more aspects into my life other than just a job, and hence one of my motivations to move away from the trading into where I currently am. When you're on that trading floor, if you picture that, you've got all those people, they're not all doing the same thing. The product that my team focused on was for long managers who are going to hold their stock, hopefully, because it's doing well and they picked it for the right reasons. Going to hold it for a long time. But while you're doing that, you've still got a lot of other things that will happen to it. So you have to put it somewhere. So you have a custodial bank that's going to look after it. But they're going to want fees for doing all the things that happen on a stock, like a corporate action or paying a dividend, and just holding your assets. They're not going to do that for free.
Okay.
So with that, if you're just holding the stock, you've got to finance that. So yes, of course, you can take it out of your own trading profits from your fund, or you can let somebody like myself make money using your stock on a different investment time frame than your time frame. So we had a legal agreement that basically said, this is your stock, it always is your stock, but you've given us permission to hopefully make you some revenue in the short term. There's no risk to you, but you're going to earn a little bit of nice cash along the side that then you can use to offset your fees and your costs in running your own business, and hopefully have some profit as well to put into your overall overhead.
Okay. So is that like you'd be selling options and doing that type of thing? Company will volunteer with their assets and say, okay, you can invest these in the short term or do option trading with them, and that's fine. But that's not done, I'm assuming, for somebody who's just got stocks in a brokerage account.
No. I think so. The industry is evolving, and the product that we worked on is evolving, and a lot of the funds who do have retail investors assets may be doing this and do this internally themselves to make sure that your retail investors have a lower cost of operation, because they use the cost of this to, say, finance those holding those equities, and therefore they can pass that on to their investors. Your BlackRocks and your Vanguards, where people have got passive investment, and they want to get it as a low
expense ratio.
Exactly, they really want to have like as few bips going on as possible. And that's the attractiveness of it. Now the more you can reduce the cost of running that business through other aspects, the better it is for your retail investor coming to buy that product, because they don't have to pick up all those extra costs.
Okay.
So then the natural question is, well, what sort of things can you do with the stock? If you're holding it for the long term, what can I do with it on a different investment time frame? So I would find for example, a hedge fund that has a short-term view on a situation in the market. For example, may short a stock. Now for this, they're going to borrow the stock from me, and effectively from my long fund. They're going to sell it in the market. Hopefully the price goes down, then they buy it back. They will then give us a stock back, and the hopefully for them, the difference between where they sold it and where they had to buy it back will be their profit. Now, always built into that, irrespective of where the stock goes, is effectively, to keep it really simple, a rental fee for providing that. Now, how we structure that rental fee will be driven by a lot of different metrics, like, you know, how hot was that stock to short? How much demand was there to short that? Of what time frame were they going to do it? So you put all these metrics around it to make sure that you can't run the hedge funds out of making any profit, otherwise they would never take the opportunity. There's no difference between a trading strategy and an investment strategy. An investment strategy should be over a much longer timeline. And this is where my journey's now gone. I've gone into away from the trading aspect, away from that side, to try and give retail investors, normal people, the information they need to make sure that they're making money, but also the main thing is they know how they're going to make money, but also they know why they want to make that money. So you tie what they want to do to a real need. Yes, it's great having loads of money, it's going to solve all your issues, until you go to Hollywood and you find that all those people have more issues than normal people.
That's so very true,
You're better off having an understanding of what you're doing and what you want. In terms of health insurance, say you want better work, 3 times more people in this country, this is UK I'm speaking about, have insurance for their pet than they do on their own life or their own health. And you think, well, that's ridiculous.
That's ridiculous.
So 6%,
people love their dogs.
So people love their dogs. 18% of people will insure their dog. Only 6% of people insure themselves.
That's crazy,
And that's really worrying, because if you've got a family and you've got, you know, you can't go to work long term, you've got no reserves you've built up. You might start needing to cash in your investment positions. It might be the best time to do it. There's not a lot of financial education globally.
I completely agree with that. I believe the education system's broken. They're not taught how to make money work for them. And I find that a major issue in the education system right now. And obviously financial education is the way forward, but it's just not done in schools at the moment. So it's up to people to actually seek out independent financial advice, or just wherever you can learn the information, learn it. And that's just the best way to do. And actually understand yourself, understand your own financial goals, your own investing goals, and then take it from there, because everyone's investor journey, I believe, is very personal. So everyone needs to have their own path, their own route, and their own goals.
And then you've got other aspects as you evolve. I mean, if you're a young guy, that's fine. But then as you start having more responsibilities and other things start coming to play, you've got a mortgage, you've got a couple of kids, you've got this, you've got that, then you start thinking, well, actually that evolves. Then you've got to start thinking, it's not just about your investment strategy, it's how that investment strategy fits into your lifestyle.
Guys, I just want to say, I know I always say on this channel, this is not financial advice, but Alex is a financial advisor. This video is not financial advice, but if you guys do need financial advice, I will leave a link with all Alex's details in the description below, so you can check that out if you do want to sort of set some financial goals for your lifestyle. And it's been great to have you on, Alex, today. Feel free to give this video a big thumbs up, guys, if you haven't already. Subscribe if you haven't already. And Alex, been fantastic to have you on. And hope you guys enjoyed the video. Comment your thoughts below on anything that we've talked about in this video, and invest safe.